There's a dangerous question people ask when shopping for a home. Not, can I afford this, but how much will they lend me? That single shift in perspective is where financial instability begins. Today, we're going to dismantle a common illusion in the housing market, the illusion that if a bank approves you for a $500,000 mortgage, you can safely own a $500,000 house. Those are not the same statement. One is about the bank's risk, the other is about your life. Let's break this down properly. When a lender evaluates you, they use ratios, debt-to-income thresholds, risk-scoring models, historical default probabilities. They are not asking, will this person sleep peacefully for 30 years? They are asking, what is the statistical chance we get repaid? Those are radically different objectives. If your debt-to-income ratio falls below roughly 43%, many lenders are comfortable approving you. That doesn't mean your budget is healthy. It means you fit inside a spreadsheet. Now let's translate that into reality. Imagine you purchase a $500,000 home. You manage to pay 10% down. That's $50,000 gone instantly. Liquidity evaporated. You finance $450,000 from a lender. At mid-6% interest rates, your principal and interest payment alone lands somewhere near $2,800 per month. But that number is incomplete. Add property taxes, add insurance premiums, add routine maintenance, add PMI if you didn't put down 20%. Housing is not a single expense. It is a stack of obligations. Once you account for everything, the true monthly burn rate can easily exceed $4,000. That's before groceries, before transportation, before childcare, before retirement contributions. Housing isn't just a payment, it's a system of recurring cash extraction.
Now, let's examine income. Median household income in the U.S. sits well below what's required to comfortably carry $4,000 plus per month in housing costs. Financial planning standards typically recommend keeping housing near or below 28% of gross income for long-term stability. Reverse engineer that math. If housing costs $4,000 per month, you would need to earn approximately $170,000 to $190,000 annually to stay within conservative guidelines. That income bracket represents a minority of households. So when $500,000 becomes the entry-level price in many metro areas, something structural has shifted. The price-to-income ratio has detached from historical norms. And yet, transactions continue. Why?
Because leverage creates the appearance of accessibility. Debt compresses time. It allows you to control a large asset today with a fraction of the capital. But leverage magnifies fragility. A household earning $160,000 might technically sustain the payments, but what happens when one income disappears? A medical expense surfaces, a major repair arrives, insurance premiums spike. House ownership has operating volatility. Roofs fail, HVAC systems collapse, property taxes get reassessed. Unlike rent, which is predictable under a lease term, ownership carries variability. When your housing expense consumes nearly half your take-home pay, you are no longer building wealth. You are defending solvency. That's not asset ownership. That's financial tension. In finance, margin is everything. Margin in investing protects against market volatility. Margin in business protects against downturns. Margin in personal finance protects against life. When housing absorbs too much of your income, margin disappears. Without margin, you stop investing consistently. Emergency savings stagnate. Retirement contributions shrink. Stress compounds. The house becomes a liquidity vacuum. And liquidity, not home equity, is what prevents financial collapse. Equity is theoretical wealth. Cash flow is survival. Here's where things become structural. Every participant in the transaction benefits when you buy. The lender earns interest, the agent earns commission, the insurer collects premiums, the municipality collects taxes. None of them are compensated for advising restraint. Approval maximizes transaction volume. Prudence minimizes it. So the system optimizes for approval. You are responsible for optimization of your life.
There is also a cultural layer. Homeownership has been framed as a milestone of adulthood and wealth building. But context matters. In prior decades, home prices were typically 2 to 3 times median income. In many markets today, that ratio is double. When asset prices rise faster than wages for prolonged periods, affordability erodes. That's arithmetic. You cannot compensate for structural misalignment with budgeting discipline alone. What sustainable affordability actually looks like? Affordability is not, I can make the payment. Affordability is, I can make the payment. I can invest for retirement. I can absorb a job disruption. I can fund repairs without debt. I am not financially anxious every month. That is the threshold. And for many households, that threshold exists at a purchase price significantly lower than $500,000. That might mean a smaller home, a different location, a longer saving period, or continuing to rent while investing the difference. There is no financial penalty for patience. There is a severe penalty for overextension. The strategic alternative. If renting costs less than owning in your market, the delta can be redirected. Invested consistently in diversified assets over decades, that capital compounds. Wealth accumulation is driven by savings rate, investment consistency, time horizon, risk management, not by granite countertops. Homeownership can be a powerful wealth tool, but only when the numbers align. When they don't, it becomes a liability masquerading as an asset. A bank's approval limit is not your affordability limit. One measures default probability. The other measures life sustainability. Before pursuing a $500,000 property, or any property, run the full cash flow analysis. Stress test your income. Model downside scenarios. Calculate total ownership cost, not just the mortgage. If the numbers constrain your freedom, the asset is too expensive. The objective is not to own the largest house possible. The objective is to build durable financial stability. Sometimes the most intelligent financial move isn't stretching to enter the market. It's preserving optionality until the math works. Because in finance, survival precedes wealth. Always.